Let me tell you something that most investors will never admit publicly. I am waiting for a crash. Not hoping for one, not predicting one, but preparing for one. Because in my 30-plus years of managing money, I have learned that the greatest fortunes are not made during bull markets. They are made during those terrifying moments when everyone else is selling, when blood is running in the streets, when the talking heads on television are predicting the end of capitalism as we know it. That is when real wealth is created. And today, I am going to share with you the 5 stocks I would buy immediately if markets crashed 40% from current levels. Now, before you dismiss this as some kind of fear-mongering or doom and gloom prediction, let me be very clear about something. I am not saying a crash is coming tomorrow. I am not saying a crash is coming next month or even next year. What I am saying is that crashes always come eventually. They are as certain as death and taxes, and the investors who prepare for them in advance, who have their shopping list ready, who know exactly what they want to buy and at what prices. Those are the investors who build generational wealth. I have been through multiple crashes in my career. I remember 1987 like it was yesterday. Black Monday, the market dropped 22% in a single day. 22%. People were jumping out of windows. They thought the financial system was collapsing. But you know what happened to investors who had the courage to buy quality stocks during that panic? They made fortunes over the following decade. I was there in 2000 when the dot-com bubble burst. I watched the Nasdaq lose nearly 80% of its value. Companies that were valued at billions disappeared overnight. But the great businesses, the ones with real cash flows and real competitive advantages, they not only survived, they emerged stronger. And the investors who bought them during the carnage, they captured gains that changed their families forever. Then came 2008, the financial crisis. This one was personal for me because I was running a significant amount of capital at the time. I watched Lehman Brothers collapse. I watched Bear Stearns get sold for pennies on the dollar. I watched AIG, one of the largest insurance companies in the world, get bailed out by the government. The fear was palpable. People genuinely believed the entire financial system was going to collapse. And you know what I did? I bought. I bought aggressively because I understood something that most panicking investors did not understand. Great businesses survive. Great businesses adapt. Great businesses emerge from crises with more market share and stronger competitive positions than they had before. That is the mindset I want to instill in you today. Not fear of crashes, but preparation for crashes. Because the next crash is coming, it might be triggered by a banking crisis. It might be triggered by a geopolitical event. It might be triggered by something nobody sees coming. A black swan that emerges from the shadows and catches everyone off guard. The trigger does not matter. What matters is your response. So let me walk you through my framework for selecting stocks during a market crash, and then I will share the specific 5 stocks that are on my shopping list if we see a 40% decline. The first principle of crash investing is quality over price. When markets crash 40%, almost everything goes on sale. Good businesses, bad businesses, mediocre businesses, they all get dragged down together. The temptation is to look for the things that have fallen the most. The stocks that are down 60 or 70 or 80%. That is usually a mistake, because the things that fall the most often fall for good reasons. They have weak balance sheets, they have declining businesses, they have existential threats that the market has finally recognized. What you want during a crash are the highest quality businesses in the world at a meaningful discount. You want the companies that you know with certainty will still be thriving in 10 years, in 20 years, in 30 years. You want the businesses with so much competitive advantage, so much pricing power, so much customer loyalty, that no recession or crisis can permanently impair their earning power. The second principle is balance sheet strength. During normal times, you can afford to own companies with some leverage, companies that use debt to amplify their returns. During crashes, leverage kills. Companies with too much debt face existential crisis during crashes. Their borrowing costs spike. Their creditors get nervous. They have to raise capital at the worst possible time, diluting shareholders or even going bankrupt. I have seen it happen dozens of times. Companies that looked fine in good times suddenly fighting for survival when things turn bad. So every stock on my crash shopping list has a fortress balance sheet, minimal debt, massive cash reserves, the ability to not just survive a prolonged downturn, but to use that downturn to acquire weaker competitors, to invest in growth while others are retrenching, to emerge from the crisis stronger than they went in. The third principle is cash flow resilience. Some businesses have highly cyclical cash flows. When the economy is strong, they generate enormous profits. When the economy weakens, their profits collapse. These are not the businesses you want during a crash. What you want are businesses with cash flows that remain strong, even during recessions. Businesses with recurring revenue, businesses that provide essential products or services that people cannot stop buying even when times are tough, businesses with pricing power that allows them to maintain margins, even when demand softens. The fourth principle is what I call optionality. The best crash investments are not just cheap versions of what they were before the crash. They are businesses that can use the crisis to create new opportunities, to make transformative acquisitions, to enter new markets, to take share from weakened competitors. I want businesses with optionality, businesses that will be worth more because of how they respond to the crisis, not just businesses that survive it. With those principles in mind, let me share the 5 stocks on my shopping list for a 40% market crash. The first stock I would buy is Alphabet, the parent company of Google. Now let me explain why this is at the top of my list. Alphabet has what I consider to be one of the most dominant competitive positions in the history of capitalism. Google Search has over 90% market share globally. 90%. Think about what that means. When people want to find information, when they want to buy something, when they want to solve a problem, they go to Google. That behavior is so deeply ingrained that it has become a verb. You do not search for something, you Google it. This dominance generates incredible cash flows. Google Search is essentially a toll booth on the internet. Every business that wants to reach customers online has to pay Google for the privilege. And unlike most advertising businesses, Google's advertising is performance-based. Businesses can see exactly what they are getting for their money. That makes Google advertising spending very sticky, very resilient even during recessions. Businesses cut their brand advertising during downturns, but they keep their performance advertising because they can measure the return. Beyond search, Alphabet owns YouTube, which is the dominant video platform globally. YouTube has over 2 billion monthly active users. It generates over $30 billion in annual advertising revenue, and it is still growing at double-digit rates. YouTube is not just a video platform anymore. It is a streaming service, a music service, a podcast platform, an educational resource. It is becoming the default way that an entire generation consumes media. Then you have Google Cloud, which is now one of the 3 major cloud computing platforms alongside Amazon Web Services and Microsoft Azure. Cloud computing is still in the early innings of adoption. Most enterprise computing still happens on premises. Over the next decade, trillions of dollars in its spending will shift to the cloud, and Google will capture a significant portion of that shift. And here's the thing about Alphabet. The company has over $100 billion in cash on the balance sheet and essentially no net debt. They generate over $60 billion per year in free cash flow. If markets crashed 40%, Alphabet would not only survive easily, they would be buying back stock aggressively. They would be making strategic acquisitions. They would be investing in AI and other transformative technologies, while competitors are retrenching. Let me tell you something about Alphabet that most investors completely miss. The advertising business is so dominant, so profitable, that it obscures the other incredible assets this company owns. Android powers over 70% of the smartphones on Earth. 70%. That is 3 billion active devices running Google's operating system, using Google's services, generating data that makes Google's advertising even more valuable. Chrome is the dominant web browser. Gmail is the dominant email service. Google Maps is the default navigation tool for billions of people. Each of these products would be worth tens of billions of dollars as standalone businesses, and they all feed into and reinforce the core advertising machine. But then there is the AI opportunity. Google has been investing in artificial intelligence for over a decade. They own DeepMind, arguably the most advanced AI research lab in the world. They have been training large language models on more data than anyone else, because they have access to the entire indexed web. Yes, they stumbled with the initial ChatGPT response, but do not mistake a slow start for permanent disadvantage. Google has the data, the compute infrastructure, the talent, and the distribution to be a dominant player in AI over the long term. I have studied this company for years. I have met with management. I have analyzed the competitive dynamics in each of their businesses, and I can tell you that the moat around Google's core business is as wide as anything I have seen in my career. Switching costs are enormous. Network effects compound over time. The brand is universally trusted. For a competitor to displace Google, they would need to build a better search engine, which requires indexing the entire web and developing superior algorithms, and then somehow convince billions of people to change their deeply ingrained habits. It is not going to happen. At current prices, Alphabet trades at around 20 times earnings. In a 40% crash, you might be able to buy it at 12 to 14 times earnings for one of the best businesses in the world, for a company with dominant market positions in multiple large and growing markets, for a company with a fortress balance sheet and massive cash generation. That is the kind of opportunity that comes once a decade. That is the kind of opportunity that creates generational wealth. The second stock I would buy in a 40% crash is Berkshire Hathaway. Now, I know what some of you are thinking. Berkshire is so big, so diversified, so slow growing. Where is the upside? Let me explain why Berkshire is actually the ideal crash investment. First, understand what Berkshire really is. It is not just a collection of businesses. It is a massive pile of cash waiting to be deployed during exactly the kind of crisis we are discussing. As of the most recent reporting, Berkshire had over $300 billion in cash and short-term investments. $300 billion, that is more cash than most countries have, and that cash is not sitting idle. It is earning over 5% in treasury bills, generating over $15 billion per year in risk-free income. But the real value of that cash is optionality. When markets crash, when great businesses go on sale, when competitors are struggling, Berkshire has the resources to make transformative investments. They can buy entire companies. They can take large stakes in public companies. They can provide rescue financing to struggling businesses in exchange for incredibly favorable terms. This is exactly what Berkshire did during the 2008 financial crisis. They invested $5 billion in Goldman Sachs, at terms that would make a loan shark blush. Preferred stock with a 10% dividend plus warrants that were eventually worth billions more. Beyond the cash, Berkshire owns a collection of businesses with incredible resilience. The insurance operations, including Geico and the reinsurance businesses, generate float that funds Berkshire's investments at essentially zero cost. The railroad BNSF is a critical piece of American infrastructure that will move freight regardless of economic conditions. The energy businesses generate predictable cash flows from regulated utilities. The consumer businesses like Dairy Queen and See's Candies have brand loyalty that persists through recessions. And here is the key thing. Berkshire's stock price tends to hold up better than the market during crashes because investors recognize its defensive characteristics, but it still falls. In 2008, Berkshire dropped nearly 50% from peak to trough. In a 40% market crash, Berkshire might only fall 30%, but that would still create an incredible buying opportunity, a chance to buy this collection of world-class assets at a meaningful discount to their intrinsic value. I also like that Berkshire is now committed to ongoing share repurchases. Management has clearly stated that they will buy back stock whenever it trades below intrinsic value during a crash. That creates a natural floor under the stock. You have the largest, most disciplined capital allocator in the world buying back shares at the same time you are. Let me share something else about Berkshire that most investors do not fully appreciate: the insurance float. Berkshire's insurance companies collect premiums from customers and then invest that money until claims need to be paid. That float is currently over $160 billion. $160 billion of essentially free money that Berkshire can invest during normal times. That float generates solid investment returns. During crashes, when asset prices are depressed, that float becomes a massive advantage. Berkshire can deploy that capital into cheap assets, generating outsized returns that flow directly to shareholders. I have studied Berkshire for decades. I know the businesses intimately, and what always strikes me is how much the company benefits from adversity. When competitors struggle, when credit markets seize up, when fear dominates, Berkshire thrives. They become the lender of last resort, the buyer of last resort, the rock of stability in a chaotic world. That countercyclical nature makes Berkshire uniquely attractive as a crash investment. There is also something to be said for the succession plan. The next generation of leadership has been clearly identified and has been running significant portions of the business for years. This is not a company that will stumble when leadership eventually transitions. The culture, the capital allocation discipline, the decentralized structure that empowers business managers, all of that will persist. You are not buying a personality cult, you are buying a system that works. The third stock on my crash shopping list is Visa. Now let me tell you why I love Visa during a market crash. Visa is often misunderstood. People think of it as a financial company and therefore risky during financial crises. But Visa is not a bank. Visa does not take credit risk. Visa does not make loans. Visa is a technology company that operates the largest payment network in the world. Think about what Visa actually does. Every time someone swipes a Visa card anywhere in the world, Visa processes that transaction and takes a small fee, typically around 20 basis points for credit and 15 basis points for debit. They do not care whether the cardholder pays their bill. They do not care whether the bank makes money on the loan. They just clip a tiny ticket on every transaction, and they process over $12 trillion in transactions per year. 12 trillion, that tiny fee adds up to over 30 billion in annual revenue and over 15 billion in net income. The secular trend driving Visa is the global shift from cash to electronic payments. This trend has been underway for decades, but it is far from over. Cash still represents approximately 20% of consumer payments in the United States and much higher percentages in developing markets. Every year, a larger percentage of transactions move from cash to cards, and Visa captures a toll on that shift. During recessions, consumer spending does decline, and Visa's volume does drop. But Visa's costs are largely fixed. They have already built the network. They have already invested in the technology. So even when volumes drop 10 or 15% during a recession, profitability remains strong. And when the economy recovers, volumes come roaring back. What I love about Visa is the combination of quality and defensiveness. This is a business with over 50% profit margins. A business that generates enormous free cash flow with very little capital investment required. A business with a dominant market position that is essentially impossible to replicate. A business with predictable, recurring revenue that grows steadily over time. In a 40% market crash, Visa might trade at 15 or 16 times earnings instead of its typical 25 to 30 times. For a business of this quality, with this kind of growth runway, with this kind of competitive moat, that is an extraordinary opportunity. That is the kind of price that allows you to compound your capital at 15% per year for decades. Let me tell you what I particularly love about Visa's business model. The incremental economics are extraordinary. Once the network is built, once the technology is deployed, once the relationships are established, the cost of processing an additional transaction is essentially zero. That means as volumes grow, almost all of that incremental revenue drops to the bottom line. This is why Visa's profit margins have expanded consistently over time, even as the business has grown enormously. There is also a powerful network effect at work. The more merchants that accept Visa, The more consumers want to carry Visa cards, the more consumers that carry Visa cards, the more merchants need to accept them. This flywheel has been spinning for decades, and it continues to accelerate. New entrants cannot compete with an established network of billions of cards and tens of millions of merchants. The barriers to entry are essentially insurmountable. I have looked at every potential threat to Visa over the years. Cryptocurrency, central bank digital currencies, alternative payment systems, buy now, pay later. None of them pose a genuine existential threat. Many of them actually route through the existing card networks. The Visa network is so deeply embedded in global commerce that displacing it would require rebuilding the entire payment infrastructure from scratch. That is not going to happen in my lifetime or yours. The fourth stock I would buy in a crash is Costco. Now, you might be surprised to see a retailer on this list. Retail is historically one of the worst performing sectors during recessions. Consumer spending drops. Margins get squeezed. Weak players go bankrupt, but Costco is different. Costco is the anti-fragile retailer, a business that actually gets stronger during tough times. Here is why. Costco's value proposition is unmatched in retail. They offer the lowest prices on high-quality merchandise. Their private label brand, Kirkland Signature, offers name brand quality at generic prices. When times are tough, when consumers are looking to stretch their dollars, they do not stop shopping at Costco. They shop more at Costco. They trade down from full-price retailers to Costco's warehouse clubs. We saw this play out during the 2008 financial crisis. While most retailers struggled, Costco's comparable store sales kept growing. While competitors were closing stores, Costco was opening new ones, while margins compressed across retail. Costco maintained its discipline. The company emerged from the crisis stronger than it went in. Costco's membership model is also incredibly valuable during crashes. Over 90% of Costco members renew their membership each year. Once someone becomes a Costco member, they are essentially locked in. They have paid for access, and they are going to use it. This creates predictable recurring revenue that persists even during recessions. The company also has a rock-solid balance sheet. They carry very little debt. They generate billions in free cash flow every year. They pay a regular dividend and have periodically paid special dividends to return excess cash to shareholders. In a crisis, Costco has the financial strength to keep investing in new stores, to keep improving the member experience, to keep taking share from weaker competitors. At current prices, Costco trades at a premium to the market, around 40 times earnings. That premium is deserved for a business of this quality, but it does limit the upside in normal times. In a 40% crash, though, Costco might trade at 25 times earnings. For a business with this kind of competitive moat, this kind of growth runway, this kind of management excellence, that would be a generational buying opportunity. Here is what really sets Costco apart from every other retailer: the culture from the top down. This company is obsessed with delivering value to members. They cap their markup at 14% on brand name goods and 15% on private label. They pay their employees well above industry average, which reduces turnover and improves customer service. They refuse to raise prices opportunistically even when they could. This obsession with the member creates loyalty that cannot be replicated by competitors who prioritize short-term profits. The private label strategy is particularly brilliant. Kirkland Signature products are specifically designed to be as good as or better than the name brand equivalent, at a meaningfully lower price. Members trust the Kirkland brand completely. They will try a new Kirkland product without hesitation, because they know the quality will be there. This trust took decades to build, and no competitor can replicate it quickly. I should also mention the international opportunity. Costco has barely scratched the surface of global expansion. They have a handful of locations in countries like China, Japan, Korea, and Australia that are generating exceptional returns. The value proposition translates perfectly across cultures. People everywhere want high-quality products at low prices. As Costco expands internationally over the coming decades, The growth runway extends far longer than most analysts appreciate. The management team is exceptional. They have resisted every temptation to sacrifice long-term value for short-term profits. They did not compromise on employee wages when competitors were cutting. They did not raise prices opportunistically during supply disruptions. They kept investing in new stores during recessions when competitors were closing them. This long-term orientation creates compounding advantages that widen over time. The fifth and final stock on my crash shopping list is Microsoft. Now, I want to be very clear about why Microsoft deserves a place on this list. Because the investment thesis has evolved significantly over the past decade. The old Microsoft was a company overly dependent on personal computer sales, with Windows and Office licenses driving most of the revenue. That business was mature and facing secular challenges as computing shifted to mobile devices where Microsoft had minimal presence. The old Microsoft deserved to trade at a discount to the market. The new Microsoft is something entirely different. Under current leadership, the company has successfully transformed into a cloud computing and enterprise software powerhouse. Azure, their cloud platform, is now the second largest in the world and growing at over 20% annually. Microsoft 365, the subscription version of Office, has created recurring revenue streams that did not exist a decade ago. LinkedIn provides unique data and capabilities that enhance the entire Microsoft ecosystem. But what really excites me about Microsoft is their position in artificial intelligence, through their partnership with OpenAI and their integration of AI capabilities across their product suite. Microsoft is positioned to capture an enormous amount of the value that AI will create over the coming decades. Every enterprise customer is going to want AI capabilities embedded in their productivity tools, their business applications, their cloud infrastructure. Microsoft is uniquely positioned to provide all of that. The balance sheet is pristine. Microsoft has over $80 billion in cash and generates over $70 billion per year in free cash flow. They could buy almost any company in the world with cash on hand. They could withstand any recession without breaking a sweat. They could invest aggressively in AI and other growth initiatives while competitors are cutting back. At current prices, Microsoft trades at around 30 times earnings. In a 40% crash, you might be able to buy it at 18 to 20 times earnings. For the leading enterprise software company in the world, for one of the two dominant cloud platforms, for the company best positioned to monetize artificial intelligence, that is the kind of opportunity that I wait years for. That is the kind of opportunity that justifies maintaining cash reserves and staying patient. Let me explain why Microsoft's competitive position is so durable. Enterprise software is incredibly sticky. When a company builds its workflows around Microsoft's products, when their employees learn to use Excel and PowerPoint and Teams, when their data lives in Azure, switching to a competitor becomes extraordinarily difficult. The switching costs are not just financial. They are operational and cultural. People resist change, organizations have inertia. This creates recurring revenue streams that persist for decades. The gaming business is often overlooked, but it adds meaningful value. Xbox has over 100 million monthly active users. Game Pass is building a Netflix-style subscription model for gaming that generates predictable recurring revenue. The Activision acquisition added franchises like Call of Duty that have enormous audiences and monetization potential. Gaming is not a side business. It is a multi-billion-dollar segment that diversifies Microsoft's revenue streams. The LinkedIn acquisition has proven more valuable than most people expected. LinkedIn is the dominant professional network globally with over 900 million members. It generates revenue from subscriptions, advertising, and recruiting tools. But the real value is the data. LinkedIn data enhances every other Microsoft product. It makes sales tools smarter, it improves recruiting, it provides insights that help businesses operate more effectively. This is the Microsoft playbook, acquiring assets that reinforce and enhance the existing ecosystem. I should also mention the capital allocation. Microsoft returns enormous amounts of cash to shareholders through dividends and buybacks. They have increased the dividend for over 20 consecutive years. During crashes, when the stock is cheap, they accelerate buybacks, purchasing shares at depressed prices and creating value for long-term shareholders. This is exactly the kind of disciplined capital allocation I want to see from companies I own. Now let me pull all of this together and talk about execution, because having a shopping list is only part of the equation. You also need the discipline and courage to actually execute when the opportunity arrives. Here is what I have learned about crash investing over 30 years. When markets are actually crashing, it does not feel like an opportunity. It feels like the end of the world. The news is uniformly terrible. Experts are predicting disaster. Your portfolio is already down significantly, and you are being asked to invest more into what feels like a bottomless pit. Every instinct in your body tells you to sell, to get to safety, to wait for things to stabilize. That is exactly why most investors fail at crash investing. They have the intellectual understanding that crashes create opportunity, but they lack the emotional fortitude to actually act. They tell themselves they will buy when things stabilize, but things never feel stable at the bottom. The bottom only becomes obvious in hindsight. So how do you overcome this? How do you actually execute when the moment arrives? The first step is having a predetermined plan. That is exactly what this shopping list provides. You know in advance what you want to buy and at what general price levels. You are not trying to make complex decisions during a period of maximum stress. You are simply executing a plan you made when you were thinking clearly. The second step is scaling in rather than trying to time the exact bottom. Nobody knows where the bottom is. Not me, not anyone else. If markets crash 40%, they could easily fall another 20% before recovering. So rather than trying to deploy all your capital at exactly the right moment, you scale in gradually. Maybe you buy a third of your target position when markets are down 30%, another third when they are down 40%, and the final third when they are down 50%. This approach ensures you do not miss the opportunity entirely, while also protecting you from additional downside. The third step is having the cash available in advance. You cannot buy during a crash if all your money is already invested. I always maintain meaningful cash reserves specifically for opportunities like this. It reduces my returns during bull markets, but it allows me to act aggressively during crashes, when the best opportunities arise. The cash is not idle. It is an option on future opportunities. Let me also talk about what not to do during a crash. Do not try to catch falling knives in low-quality companies. Yes, some stock that has fallen 80% might seem like an incredible bargain, but stocks that fall 80% often fall another 80% from there. They fall for reasons. The reasons do not disappear just because the stock is cheaper. Do not use leverage to buy more during crashes. I know this is tempting. Prices are low. Opportunities seem everywhere. And leverage would amplify your returns when things recover. But leverage also amplifies your losses if things get worse before they get better. People have been wiped out using leverage during crashes, even when their fundamental analysis was correct, because they could not survive the volatility. Do not sell your existing high-quality holdings to buy other high-quality holdings at lower prices. This seems clever in theory, harvesting tax losses and repositioning into better opportunities. But in practice, it often goes wrong. You sell something at the bottom, buy something else that continues falling, and end up worse off than if you had just stayed put. If you have cash, use the cash to buy. Leave your existing positions alone. I want to address one more thing before I close, and that is the psychological component of crash investing. The people who succeed at this are not the ones with the highest IQs or the most sophisticated models. They are the ones with the right temperament. They can watch their net worth decline by 30 or 40 or 50% and not panic. They can tune out the noise, ignore the predictions of doom, and stay focused on the underlying value of the businesses they own. This temperament is partly innate and partly developed through experience. If you have never been through a major crash, you do not really know how you will react. The first time your portfolio drops 40%, it is terrifying. You cannot sleep. You check prices constantly. You question every decision you have ever made. But if you survive that experience without doing anything stupid, if you hold your positions and even add to them, and then you watch your portfolio recover, and eventually reach new highs, something changes in you. You realize that crashes are not permanent. You realize that panic selling is always the wrong move. You develop the confidence to act rationally during periods of maximum fear. So if you are a younger investor who has not been through a major crash yet, understand that it is coming. Use this time to prepare psychologically, read about historical crashes, study what happened and how long recoveries took. Build conviction in the businesses you own so that you will not abandon them when things get scary. Develop a plan for how you will respond, and commit to that plan in advance. The 5 stocks I have shared with you today represent what I believe are the highest quality businesses available in public markets. They have dominant competitive positions, they have fortress balance sheets, they have management teams that have demonstrated the ability to navigate difficult environments. They are businesses that I am confident will still be thriving and growing 30 years from now. In normal market conditions, these stocks trade at premium valuations because the market recognizes their quality. But in a crash, that recognition temporarily disappears. Fear overwhelms reason. Investors sell indiscriminately, and for a brief window of time, you can acquire pieces of these extraordinary businesses at prices that dramatically undervalue their long-term earning power. That window will not stay open long. Crashes feel like they last forever when you are living through them. But in hindsight, they are brief interruptions in a long-term upward trajectory. The COVID crash in 2020 lasted about a month from peak to trough. The entire recovery took less than a year. Investors who bought quality stocks during that panic saw their portfolios double in 18 months. I do not know when the next crash will come. I do not know what will trigger it, but I know with certainty that it will come eventually. And when it does, I will be ready with my shopping list in hand, my cash available to deploy, and the temperament to act while others are panicking. That is how wealth is built. Not by predicting the future, but by preparing for the opportunities that volatility inevitably creates. So keep this list somewhere accessible. Review it periodically, update your own thinking about these businesses, build your cash reserves, develop your emotional discipline, and when the opportunity arrives, when markets are falling and fear is everywhere, and it feels like the worst possible time to invest, act. Because that moment of maximum fear, that moment when every instinct tells you to run away, that is precisely the moment when fortunes are made.